Hey folks, welcome back to the channel. Make sure to subscribe, like, hit that notification bell. That way you are getting the most up-to-date videos that we're putting out today. And here's a question most successful business owners avoid asking. What happens if revenue drops 20%? Not because you failed, not because the sky is falling, but because growth typically cools, margins can compress, or the market just normalizes. This isn't a doomsday scenario, it's realism exercise. The most resilient companies don't panic during downturns, they already modeled them out. Today, we're going to walk through a practical stress test for your business, your personal cash flow, your tax strategy, and your estate structure. So you're not hoping things hold together, you know they will. Let's be clear, this is not a recession prediction, it's a maturity check. After several years of elevated growth in many sectors, we're now in a more disciplined environment. Think about it, higher cost of capital, sticky labor expenses, rising insurance premiums, customers becoming more selective. Translation, the easy growth phase is behind us. If your current lifestyle, compensation, and personal planning assume peak revenue continues indefinitely, you don't have a strategy, you have momentum. Momentum works until it doesn't. Stress testing is what replaces hope with math. Let's look at the business level stress test. When we run stress tests with owners, we begin with EBITDA. Now, if you're not in Finance Daily, EBITDA stands for earnings before interest, taxes, depreciation, and amortization. In simple terms, it's a proxy for operating profitability, what your business earns before financing costs and accounting adjustments. Think of it as the engine power of your company. Now, here's the key question. If revenue drops 20%, what happens to EBITDA? Does it drop 20% or does it drop 40% because fixed costs don't shrink proportionally? Many businesses are more operationally leveraged than owners realize. So we look at fixed versus variable costs, the break-even revenue level, debt service coverage ratios, and cash reserves. If EBITDA compresses significantly, do loan covenants still hold? I don't know. Is there breathing room in your credit facilities? Are you still comfortable funding growth initiatives? If the answers are unclear, that's not a disaster, it's just unfinished planning. Now let's move from the business to you. If distribution slow by 20%, does your personal cash flow still work? Are mortgage, tuition, lifestyle, and investment commitments flexible? Do you need to reduce retirement contributions? Would you have to tap reserves? Many owners live at a spending level built during peak years. That's not reckless, it's just human nature. But when personal cash flow becomes dependent on perfect business performance, flexibility disappears. The goal isn't austerity, it's optionality. A well-designed personal financial plan can absorb volatility without panic. Now, let's layer in taxes. When revenue declines, the instinct is often to reduce W-2 wages, pool fewer distributions, pause retirement contributions, but those decisions have tax consequences. For S-Corp owners, shifting between salary and distributions affects payroll taxes. For partnership owners, timing of income allocations affects estimated payments. If you don't model the interplay, you can accidentally underpay estimates, over-withhold, miss bracket optimization opportunities. A 20% revenue drop doesn't change income, it changes the sequence of income. And sequencing is everything in tax planning. Now, let's talk about your portfolios. If business cash flow slows, your personal portfolio may need to shoulder more stability. Ask yourself, is your portfolio designed purely for growth? Do you have liquidity buckets for 12 to 24 months of expenses? Are you overly concentrated in your own company or industry? When business performance dips, emotional risk tolerance dips too. If your portfolio is aligned correctly, volatility becomes background noise. If it's misaligned, volatility actually becomes stressful. This is where asset allocation and liquidity design intersect. Stress testing often exposes something else. Risk concentration. If revenue declines and you experience a disability event, a key employee loss, a lawsuit, or a buy-sell trigger, do insurance structures still hold up? Many owners haven't revisited their key person coverage, their buy-sell funding agreements, their umbrella liability limits, or the disability protection tied to current income. A slowdown is manageable. A slowdown plus an uncovered risk, that's not. Finally, Consider estate and succession planning. If EBITDA compresses, valuations change. If valuations change, gifting strategies and trust funding may shift. If liquidity tightens, estate liquidity becomes more important. Estate planning isn't about death, it's about continuity. If your business underperforms temporarily, does your legacy plan remain intact? That's the real stress test. Here's the takeaway. If your plan only works when everything goes right, it's not a plan. It's a best case scenario. Most sophisticated business owners we work with don't assume disaster. They simply run the numbers before the numbers run them. Stress testing isn't pessimism, it's leadership. And the calmest owners in turbulent environments are the ones who modeled the turbulence in advance. So if you need help stress testing, reach out. We are here to help. That's all I got for today. Have a good one.